Okay, ladies and gentlemen, let's try a last short chapter, which forms the logical, let's say, paramount or final point of the topic for methods for the avoidance of double taxation, and that is case studies with more realistic situations, so where combinations show up. What you should keep in mind naturally is that in real life, taxpayers do not have only one cross-border investment, at least not the rich ones. So you will have income from several sources, from several states. So in some states, there might be a double taxation treaty in place. In other states that don't have a DTT, so you will have to apply the unilateral rules of Germany, paragraph 34C, and so on. So in a realistic case analysis, you will always have to reflect for every single event which method for the avoidance of double taxation applies, and then how to go on and deal with all of that. Yeah, and so a few things are there which you can directly memorize. For example, the exemption method is only granted by Germany in a double taxation treaty. So if you do not have a double taxation treaty with that other country, you can directly say this is not our option. And then you would have to decide otherwise between application of the credit method or escape rule the deduction method in case where nothing else works. And so that is, for example, how you can orientate yourself on the way through the case. Let's first sum this up again in a slight overview or a bit overview, and then go on. So let's first repeat some basics. If foreign taxes are mentioned, how do we deal with them? That's the question. So let's think about it. Let's remember what you already know. That is, if foreign taxes are mentioned, there are only 4 possible reactions which you have to a foreign tax. The 4 methods for the avoidance of double taxation. So exemption method, credit method, deduction method, and last but really least, the lump sum method. Now, the lump sum method is something we directly can cross out. It doesn't happen. So the first 3 ones remain. So for testing an event, this means first, if there is no double taxation treaty, then the exemption method is out. So check if the credit method is allowed. If not, treat the foreign tax as a business expense. Now, afterwards, after testing all events, make a list with all the taxable income and the tax rate relevant income, right side. Compute the tax. And again, afterwards, if there are credit method items, compute the credit method now. So, to sum it up again, first, test each event and calculate the tax base. Second, sum it all up and calculate the tax, including proviso if necessary. And afterwards, apply credit methods where credit method is necessary. That's the whole secret. Yeah, so here is the one and only case by which I want to illustrate how complex cases would work. That's here Mr. Komp from Kleve in Germany. And Mr. Komp, a citizen of the combination naturally, has income from following sources. Job income from Germany, probably no No problems here, 50,000. Then income from a house in the non-double taxation treaty country of farawayistan, which is far away, naturally 50,000. In that country, a tax of 15,000 out of these 50,000 had to be paid and has been paid and will never come back. Income from a factory in France, which is tax-free under the relevant double taxation treaty, 200,000. And income from a house in the Netherlands, tax-free under the DTT with the Netherlands, 60,000. Special expenses and similar stuff amount to 20,000. That's the case, and that is where we have to work on. So let's just begin at the beginning, and that is what we are going to do just now, immediately. Okay, so the beginning is simple. Personal tax liability, as always, ladies and gentlemen. Mr. Comp is a natural person, so it's an ESTG case. The ESTG applies its unlimited tax liability under 1.1 ESTG because lives at Cleaver, so in the inland. Now let's go to the events, and there we have 2.1, the job and Cleaver. The job is to be subsumized or to be identified as income from employment. That can be looked up in 19.1, number 1 of the ESTG. So this is a part of the worldwide income. You can see that in the list of the 7 types of income here in paragraph 2.1. The tax base which we need is the surplus of revenue over expense. That's number 2 ESTG, and that is here given as 50,000. By the way, 50,000, that's a nice salary. We couldn't be happy with that. And yeah, then we are going to have number 2, the house in farawayistan. That's income from lease and rent. Yeah, that can be checked in 21.1, number 1 ESTG. There's a definition. So if it's income from lease and rent, then it's a part of the worldwide income, because it's one of the 7 types of income. So number 6 ESTG. The tax base which that particular type of income requires is the surplus of revenue over expense again. Income related expense to be exact. Then we have that here given as 50,000. So now we have no DTT, so no exemption. We have now to check if credit method applies, if that is applicable. If so, then it would be a clear thing that the deduction method is not to be applied. So we have to check paragraph 42 through 34C. I never get this word pronounced correctly. So we have unlimited tax liability. Yes, see above. We did this in the introduction already. Then the next thing what we have is definitively, is it foreign income? And now if we check 34D, number 6, or is it number 7? I must look it up naturally. 34D. One can never trust one's memory, so one should look it up. Here you see the page is turning. It's number 7. Number 7, ESTG. No, wrong key or position of my hands. So that's a yes, because the foreign property is in a foreign state. Is it an income tax which has been levied and not a dog tax or something else? Yes, see case data. There was a tax levied by that state in which the income has been earned. There the answer is yes. See case again. And was it assessed properly, paid, and no refund claims ever? And this is also yes. So the conclusion is the credit method can be applied. And the next conclusion is then, as a consequence of this, no deduction method. So no deducting or no deduction of these 15,000 from the income. So here, later there will be a deduction, accrediting against the income tax burden, but not from the income. That follows from paragraph 12, number 3, ESTG. The basic rule is income taxes, the domestic ones and the foreign ones, are no business expense, no income related expense. Only in case of the special rule of the deduction method that can be deducted, but that's not the case here. So, okay, we have income here of 50,000 remaining. 2.3, the factory in France. That's income from business. 15.2 plus paragraph 15.1, number 1. And if you look it up, you find out 15.2 says that a factory indeed is a business activity, and 15.1, number 1, says who has to be held responsible for the income from the factory. And in case of a sole tradership, the answer is the owner. Okay, so part of the worldwide income. Now you ask probably, why do I look for that? And the answer is, if it's tax-free, there might be a proviso, safeguard, and progression, and then I need the amount, and I need the proof that it's indeed income. Oh, the tax base is the profit for this type of income, to number 1. Here given as 200,000, but tax-free under the DTT, so taxable is 0, but relevant for the progression. 32B1 number 3 ESDG says yes, 200,000, and the exceptions from the proviso clause laid down in 32B sentence 1, sentence 2, numbers 1 to 5 do not apply. And where do I know this from? First, from looking it up. Second, from the insight that a factory is not a risk-free, so-called passive foreign investment. So that's it. So relevant for progression is 200,000. Okay. Now, the house in the Netherlands. Sorry. It's income from lease and rent again. Paragraph 21(1), number 1 ESTG. So part of the worldwide income. Paragraph 2(1), number 6 ESTG. Tax base, the surplus of revenue over expense. To number 2 here given as 60,000, but tax-free under the DTT, so taxable is 0. Relevance for the progression, and here according, you need to know this is an EU case, and a house is a very risk-free investment. So what we could do here is run a tax-saving model founded on the tax rate relevance of the foreign income from the house. That tax-saving model has been explained in one of the former lectures. So in order to exclude the possibility to make use of such a tax-saving model, we had that peculiarity here in German law, and probably German law only, that the losses and profits from foreign so-called passive investments, tax-free under DTT in the EU, are regarded as not relevant for the progression. Sentence 2, number 3, ESDG, not relevant for the progression. So relevance for progression here also 0. Now let's have a look, please. Check if you can in 32b of the ESDG if it's really in the second sentence, number 3. Yes, it is. So what we can do now is adding it all up and calculating the tax. Well, what we have is taxable income and we have tax rate relevance. Taxable income is 50,000 and we have here 50,000. Naturally, what is taxable always plays a role for the tax rate too. We have 50,000 from far away on which were taxable because the credit method applies, and things under the credit method always count for the proviso too. Then we have 0 taxable from France, but 200,000 relevant for the tax rate. Then we have a house from the Netherlands, not relevant for the tax rate. So we can have a subtotal for all the income. That was 100,000 and relevance was 300,000. Now minus 20 for the special expenses. So we see that we have a taxable income of 80,000 in this case, which has to be taxed with the rate for 280,000. Now, for 280,000, the tax would be, according to the tariff for 2022, 0.5x minus 17,602.28. That is only valid for this year, so you should know or notice that for future years this will probably change. Might even be that in future years this is no longer the 45% bracket, because the 45% bracket at the moment begins at 277,000. So an adjustment in that way that in the future perhaps this is the 0.42 bracket is not unrealistic, or a complete change of the tariff function, because one never knows. But the basic logic is naturally the same. So what we have here is this now. So 108,030. That is in percent 38.7134%. Now that rate applied to 80,000 brings us to a tax of, that is now fascinating calculation, 30,907.77. Okay, let's kill the cents because it shall be rounded down officially to an even euro. Now we have number 4, the application of the credit method. For the credit method, we need first the foreign income, which is in play. Then we need to calculate the credit limit for the credit on the foreign. What do we have? 50,000 from faraway stuff. Remember, income from each individual state is calculated differently. So we take that times the personal tax rate of the taxpayer. The personal tax rate is the average tax rate. We have already calculated this during the calculation of the data which we needed for the application of the tax rate here when we calculated the proviso. 34%, and this brings us to some 19,000, I think. 13.71, 34%, 19,356, and some 70 cents or so. Nobody knows, and nobody cares, probably, apart from members of the fiscal administration. Paid there was 15,000. So credited can be the full 15,000 because the maximum is higher. So the final tax to be paid in Germany will be the tax which is due under the tariff minus the creditable amount. And this is 39. 93. Oh my god. 93,000. I hope at least so. That was calculated in my head. So this is our final result, ladies and gentlemen. And so a complex case will work